Welcome back to the Money Show. Let's get started with our second discussion, wherein we're going to be putting the spotlight on sectoral funds. As an investor, what is the right time to take position in a sector? In situations where a sector is beaten down significantly, what should be your approach towards those sectors? Let's get answers to all of these questions with Kaustubh, who is the Director, Fund Research at Morningstar Investment Advisers India. Very good evening, Kaustubh, and thank you so much for your time to ET now. Firstly, the consensus advice that comes from the experts is that stay away from sector funds. Today, we're going to not just be discussing about the sector funds, but also try to guide our viewers that if a sector is actually a beaten down one, and if it is poised for a rebound or a recovery, what exactly is the right time to enter that particular sector. So firstly, let me start and try to put in context, as per your take, that how do you see sector funds as an investor? What are the pros and cons of investing in a sectoral funds?
Sure. Hi, and thanks for having me on the show. And I think a very interesting point for discussion, right? Because obviously, sectoral funds are a popular segment of the market. But like you alluded to, that there are pros and cons, and I'm firmly in the camp of that. Most investors are better off avoiding sector funds because the nature of the market is such that there is constant sector rotation that happens through the market. So yesterday's winner is probably at the bottom of the pile the next year. So that's very important from an investor's perspective. Unless and until you have the wherewithal, the time to do fundamental analysis of the drivers of a sector, which honestly, in terms of time or expertise, most investors wouldn't have. I would not recommend, entering into a sector fund to start with. Even when you think about, diversified equity managers, right? What they do is they take graded exposures, underweight, overweight exposures to sectors. They do not make it a binary equation of going 0 or 1 in a particular sector, depending on the view. And that's probably a better method for most investors on the street to look at. Where you want to take a sector exposure, do it through, rather think about, diversified equity funds as a means of doing it, rather than buying into a sector fund, because what it can result in is very, very lumpy performance. Either it's doing really well or it's fallen off the cliff. So I think that's the thing that investors really need to keep in mind. If you don't have the wherewithal, the expertise, you're just better off staying away from sector funds. And if you look at, I spoke about the cyclicality of sector rotation, right? Just more recent few years, you can see the data. It's for all of us to see. For instance, technology was the darling of the street, and in 2021, as things were coming out of sort of the first wave of COVID, tech stocks did really well. But we all know the struggles they've gone through last year and some part of this year, right? So it is probably one of the lower sort of returning sectors, especially in the year of 2022. Similarly, we had healthcare, which initially did really well and then had tough years, and that's coming back up the curve slightly on a relative sense. This year, if you look at it year to date, probably the capital goods segment is doing exceedingly well. Autos are doing well, which probably weren't exactly the top of the pile in the previous years. So the point that I'm trying to make is that it's very hard to predict which sector is going to come to the fore, because there are a lot of market forces at play, macroeconomic, global, domestic forces at play, which would move sectors and stocks. I think most investors would be better off, buying diversified equity funds and let the fund manager express his or her view, underweight or overweight calls, to a more graded sector exposure rather than a binary 0 or 1 sector exposure.
Okay, thank you so much, Kaustubh, for putting all of that in context. But I'm just trying to put that framework in place so that we can dive deep and understand from you how the allocation could be. Because in India, everybody is positive on the long term and the India growth story. And we have seen so many sectors, like you were highlighting, IT, pharma, they have been the darling of the streets back then. But now if we see these sectors, there are not many options available when it comes to sectoral fund investing. So just wanted to understand, for the benefit of our viewers, that which are some of those actively managed or some of those interested areas where we can, as an investor, can find sector funds, because there are not that every sector has a sector fund which is being managed by professionals. So which are some of those actively managed sector funds that an investor can look at?
Yeah, sure. So purely from, what are the options available? Obviously, you would find, like you said, there are a lot of, technology-based funds that are available. You would find a lot of consumption, while not necessarily linked to one particular sector, but more about, sort of thematic consumption-based funds. There are a lot of pharma and healthcare funds that are available. But I think from an investor's perspective, and just thinking aloud, and that's where, I think I would really want to emphasize on the point that timing becomes so crucial to an investor's entry and exit. So even while all of these options are available, let me illustrate that through another interesting data point and study that we had done. So technology is an example that I alluded to. 2020 was obviously a stellar year for technology stocks, did exceedingly well. What we saw from an investor behavior perspective, looking at the past performance of the sector, investors heavily piled into tech funds come 21, 22. And 22 was in fact the worst year for technology on a relative to all the other sectors. So what that resulted in, when we call it the concept of investor return. What is the average investor made in that fund versus what the fund has returned? So we ran the study, sometime last year, and data as of 30th June 2022. What we observed was that the funds have returned a CAGR of almost 27%, right? So great. So investors like, wow, the fund's done 27% 3-year CAGR. That's amazing. But an average investor invested in those funds made only about 3-odd%. Why did that happen? Because the bulk of the money came in after the run in the sector had already happened. So the worst thing you can do as an investor, even if you're interested in a sector fund, is buy it when it's already run up significantly. You might want to look at sectors that are probably underperforming over the short term. And even if you get into those, buy in a graded exposure. Do not break the bank and buy a very large part of your portfolio in a sector fund. And you'll have to be patient, right? Because the turnaround may not happen immediately. It may take a year or two. So don't sell in panic because the sector is going nowhere. But, like I said,
that was, I think we have just snapped that line with Kaustubh. We'll try to get him back. But the point that he was trying to make is that the timing is very important when you are investing in any of those sector fund. And case in point being, he was just highlighting the IT sector as such, because as an investor, if somebody who has been into that particular fund has actually earned a very handsome return, but if you have invested or started investing in at the almost at the top of the return candle, if you will say, then that could not generate great returns to you. So that's the advice coming in from Kaustubh, that how to get your timing right. We will definitely try to get an answer to that. So let's and I guess that Kaustubh is back with us onto the Zoom line. So Kaustubh, please go on. You were making a point onto the how the IT funds have done and how the timing is very important. Any further point that you make to your answer?
Yeah, so I think obviously, like I've just kind of reiterating my point that entry exit becomes very important to a sectoral fund. So even if you buy when the sector has already run up significantly, you're at the biggest risk of then the sector going through cyclicality and you actually underperforming versus the broader market or other sectors. So perhaps if you are really gung-ho about buying a sector, a good time would be when it's kind of relatively beaten down, but also two things. One is don't break the bank and buy too much of your portfolio into a sector. Typically 5% would be enough. And more importantly, be patient, because the sector could potentially underperform for a couple of years. For the growth drivers to really pick up, and so you need to be patient in the investing. But like I said, for most investors, best let the active fund manager in a diversified equity fund take that graded exposure, overweight, underweight calls to sectors. The other thing, which is probably interesting from an investor's perspective, is now there's what we call thematic funds, right? And we've seen quite a few of them come to the fore over the last few years. And I think there's something like a business cycle where it's a more concentrated sector, overweight, underweight, unlike a diversified equity fund, could be an interesting option to kind of think about. because the fund manager will express a much more focused approach towards certain sectors depending on his or her conviction on a particular sector vis-a-vis the same diversified fund that the fund manager would be managing. So that's probably one thing that investors can look at if they want to take a slightly more interesting sort of sector exposure, but again run by an active manager. I would recommend, not purely getting into a single sector fund.
Okay, Kaustubh, but in the markets, there's a very famous quote which was actually used by late Mr. Rakesh Jhunjhunwala. Pardon me if my pronunciation is not correct, because this is in Gujarati, which says that vadhare vadhare levanu, ghatate ghatate vechwanu, which means that anything that is rising, keep buying that, and anything which is falling, you can stay away or you can short that, because that's expected to fall even further. But now what we're trying to help our viewers understand, that when you are planning for investing in a sector fund, how can you catch that that the tide has now turned, and when that could be a proper time where you could actually make your investment journey started in a sector fund. Definitely it's not that easy to get that bottom or the top of the move right, but like you were mentioning, IT, pharma, they haven't done that well in comparison to the rest of the sectors that we have seen, especially in the last couple of years. So what's your take on how to get started with some of the sectors that have actually beaten down in the markets and haven't seen such great returns? What will be the stepping stones or the baby steps for that?
Yeah, so I think, and again, I think the underpinning sort of thought is obviously, you'd want to look at sectors that, and that's a more broader thought, right? That, sectors that have not done well recently, but the fundamental analysis remains key, right? And my sort of, question to the investors, that do you want to spend the time, or do you have the expertise to do that? Because, you would have to look at the fundamental drivers, because there can be sectors that are probably going through a structural sort of cycle and downturn, which could be elongated for a period of time. And when I think about it as a retail investor on the street, even if you get into a sector probably at the right time, for instance, when IT was beaten down, say, in 16, 17, if you bought it then and just held on, to your patience, it would have paid rich dividends over the next, 2-3 years. But did you have the patience and the understanding to hold on? And I think that is the biggest challenge. So the fundamental sort of drivers of each sector will be different, and you'll have to kind of understand that. Probably one way of doing it, and this is not necessarily advice, but just thinking aloud, is you look at what exposures are the broader consensus managers kind of taking, because it would allow you to think what are the active managers thinking in terms of the sector bets, right? While they take more graded bets, if you are a little more nuanced investor, you can do that analysis to figure out that where are the managers, the active managers, kind of putting their bets in, and we can see that they've consistently been adding exposure to, say, cyclicals, industrials over the last year, maybe a little bit of pharma, and that's really the trend of the street. But again, I think my overarching advice would still, for a majority of investors, still, and I can't strongly emphasize enough that you're probably best off just staying in diversified equity funds and let the active manager do his or her job.
I have to ask you that currently, because you do all those research that how the returns has been in many of these sector funds that are available, as well as how they have performed. So given your study, how do you see that which sectors are gaining the most traction or are lucrative, looking lucrative to the investors out there?
So I think obviously in terms of beaten down sectors, you probably have technology and sort of healthcare, which are more kind of just have been relatively underperforming. But like I was alluding to, when you think about what is the broader consensus market in terms of active managers doing, and that's I think a very good viewpoint to look at. You can clearly see that there's a lot of excitement or addition of, say, the capital goods, the industrials, where you're seeing a lot of funds going overweight, and clearly with the whole thrust on the manufacturing, the PLI incentives is really adding to a lot of sort of excitement or interest around there. So maybe themes like manufacturing could be a longer term play, so to speak, when you read the market tea leaves also in terms of, what the active managers are doing. Right. So I think those are some of the things that, we're seeing in terms of the market. I touched upon healthcare, and I think consumer cyclicals is also another area where, managers have been actively adding on sort of exposures. Obviously, some of these segments have already done well. So, that's something you'd also need to keep in mind when you're looking to enter some of these sectors or themes.
Consumer cyclicals, healthcare, as well as industrials are some of the sectors that that has been on these fund manager radars. But before Kaustubh, we let you go on that, just wanted to understand from you, what will be your advice for somebody who is looking for investment in these sector funds? How can the allocation look like? Any advice on the same?
Yeah, I would say that, typically try to limit your sector exposure to your, sort of tactical exposure of typically not more than 5% to a sector, and do not, own your overall portfolio not more than 10% if you do want to take, so that, it's money that you're okay that, if it underperforms and it's only a tactical part of your exposure, your core portfolio should still, stay away from sector funds is, the overarching advice that investors should follow.
Okay, Kaustubh, with this, we'll let you go on that. Thank you so much for joining us today on
Thank
ET
you.
Now and helping our viewers understand that how to go about investing in sector funds and how to go about investing in beaten down sectors as well. But with this, viewers, it's once again time to slip into a very short break. Don't go anywhere, because as we come right back, it will be time to take all your portfolio related queries live onto the show. You can connect with us live as well, and we'll try to find an answer to that with our experts. But before that, slipping into a very short break, don't go anywhere.